Ah, the stock market, a place where the rich get richer and the little guy just can't win, right? Maybe not. I encourage you to put your biases aside for a moment so that we can unpack this topic. The U.S. stock market, which is often represented today by the S&P 500 or the Dow Jones Industrial Average, has been around for a very long time, over 200 years. The very first stock market in Europe came even long before that. So, people have been making money off of publicly traded companies for quite a long time. Of course, as the world has changed, so has our financial system. In fact, the dollar used to be backed by gold. Now it's backed by our faith in the U.S. government, which many people don't actually have much faith in that. So hence the rise of cryptocurrencies like Bitcoin, but that's another story. You see a lot of people these days claiming that the stock market is completely rigged, only for super wealthy people and institutions, and yada yada yada. And yes, they have a leg up, certainly. There's no denying that. Big institutions have access to the markets that the average Joe or Jane doesn't, and wealthy people are more likely to even invest in the first place. But is it an impossible place for everyday individuals to build wealth? Is it really rigged, so to speak? Many people claim that it is because of the Federal Reserve, also known as the Fed. The Fed is responsible for monetary policy, which is fancy speak for setting interest rates and making sure our banking system functions properly. The Fed can lend to banks, buy certain assets like bonds and gold, help keep certain markets afloat during crises, and more. What the Fed is doing is they're basically paying attention to economic factors like unemployment rates, GDP growth, inflation, and more to determine how to maneuver interest rates. And interest rates affect everybody in more ways than one. How much you get paid on your savings, how much interest you'll have to pay a bank if you buy a home, just to name a few examples. And higher inflation, which is also known as the rising cost of goods, usually leads to the Fed hiking interest rates higher to curb the demand for goods and services so that prices don't get out of control. Lower inflation or deflation, also known as prices are staying stagnant or declining, usually leads to the Fed lowering interest rates to spur demand for loans and credit to get people buying more goods and services and stimulate the economy. So this is the general idea. So yes, the Fed does important things that can have influence on our economy and our markets in broad terms, especially if they do stupid things like hike interest rates too high while we're still trying to recover from economic shocks. So I hear a lot of speak around the Fed being the reason for the amazing returns that the stock market has had over the past decade specifically. Many mention that we should all be preparing for an epic crash too because of this. And there is some truth to the Fed influencing our stock market, but there is also a point where people might be giving the Fed too much credit here. First of all, the Fed does buy bonds, but they do not buy stocks. Could that happen in the future for the Fed to buy stocks? Maybe, but right now it's not. So, what are they doing then to push stocks higher, as many claim, if they're not buying stocks? Well, they've lowered interest rates. Here's the actual federal funds rate over the decades, and you'll see that interest rates have trended lower. The 2008 financial crisis was a real doozy on the economy, and interest rates stayed basically zero until 2016. That's quite a long period to have such low rates. Note that for later, please. You'll notice that the Fed started raising interest rates from 2016 to 2019, and we were seeing over 2% on our high-yield savings accounts for a sliver in time. Remember how glorious that was? That was awesome. And then bam, 2020 came along, and here we are back at 0% as inflation has started to increase significantly in the US. So what does all this mean? And is the stock market actually rigged? As investors, our goal is to make a return that is at or above inflation over time. If not, our money completely loses its purchasing power. So low rates mean investors typically can't get significant risk-free returns from bonds that may help them beat inflation. This leads them up the risk spectrum. So let me explain this phenomenon of the Fed forcing people into risk assets like stocks. If we look at the risk spectrum here of different assets, some assets have less risk associated with them, but with low risk typically comes lower returns. Treasury bonds and cash are good examples of no to low risk assets. But they pay diddly squat, especially right now. Higher risk assets like stocks, commodities, or even cryptocurrency offer higher return potential, but much more risk of those roller coaster ups and downs in prices. So if rates are low, and you can't really beat inflation by investing in lower risk assets like bonds, well, how the heck else are you supposed to keep up with inflation? Yeah, you guessed it. You're going to have to move up the risk spectrum and invest in assets like stocks to get any reasonable return on your money. So, although the Federal Reserve isn't buying stocks themselves, when they lower rates, they naturally push people to seek returns from higher risk assets like stocks. You can see how well the stock market has actually performed during the low rate environment over the past decade. Stocks were in pretty high demand. Okay, so you may be thinking, holy crap, Nikki, the stock market is rigged. The Fed lowers rates, which in turn spurs demand for risk assets like stocks. Duh. Well, that's definitely not what I'm saying, and I haven't even got to corporate earnings yet. What I am saying is that how our economy is doing, measured by things like GDP growth, unemployment rates, and inflation, can affect how the Federal Reserve handles monetary policy and how the government handles fiscal policies, think like stimulus checks and taxation. And in turn, those policies can lead to forcing investors' hands into higher risk assets to get some return on their money. It can also lead to pure speculation. 2020, for example, was a perfect storm that affected our markets. The government's fiscal policy of issuing stimulus checks combined with high savings rates led to a spike in retail investors getting involved in stocks. It was a time for the books. Now, can the Federal Reserve and the government make terrible policy mistakes? Yes, they absolutely can. But generally speaking, you can't just blame the Fed and call the stock market rigged. There are a lot of moving parts. So let's get to the biggest argument for why the stock market is not actually rigged. Earnings, greenbacks, the cheese, whatever you want to call it. A lot of people think that the stock market is up on thin air, or the Fed, or the manipulation monster, or whatever. But the stock market, represented by the S&P 500, or the Dow Jones, or the NASDAQ, just to name a few indices, is backed by corporations. Corporations that are out there providing goods and services and getting paid by consumers and enterprises. From that revenue comes profits for our major corporations. In this chart, you'll see that U.S. corporate profits have been steadily increasing over time. Sure, we've had recessions along the way where profits dip, but guess what? So does the stock market's price, just right along with it. Earnings are the backbone of the stock market. I did a video going over how to value the S&P 500 based on expected earnings here. I suggest checking it out. So, no, the stock market isn't just up on thin air. It's up because earnings are up. Have you seen big tech's balance sheets lately? Talk about cash cows. Now, can the price of the stock market or its valuation get out of hand? Sure. Have you ever heard of the dot-com bubble? We all know things can get overbought. But this again is why it's very important to give this video a watch so that you understand what would be a below average, average, or above average valuation based on beloved earnings. So, can the everyday investor build wealth investing in our stock market? Sure, there will be ups and downs, there always have been, but overall, over the past century, the market has returned around 7% after taking into account inflation. So your money over time, if it was invested, would have grown to increase the amount of goods that you can buy. This is what we want. So you may be thinking, well, the stock market only lets the big guys win. Or maybe you think that it only benefits the wealthy. Well, many Americans actually own stocks, either directly or mostly via a retirement account. In fact, roughly 50% of Americans have assets in retirement accounts, according to the latest survey of consumer finances by the Federal Reserve. Trillions of dollars is actually expected to be passed from baby boomers to millennials, about 68 trillion to be exact. Much of that wealth held in real estate and, you guessed it, stocks. So to wrap it all up, I wouldn't call the stock market rigged, but yes, it can be influenced by the economy. If the Fed has rates at basically zero, that can create demand for stocks. Not to mention the government's fiscal policies like stimulus checks and taxation. I also think that the stock market is a viable place for everyone who wants to build wealth to do so. The market is backed by revenue-generating corporations. This is the biggest component that helps the stock market rise over time. All right, finance fam, What do you think? Let me know in the comments below if you agree, disagree, learned something new, or whatever else. Just keep it classy, will ya? If you found this helpful, please destroy that like button for me so that the algorithm shows it to more people looking to learn about money. And don't forget to subscribe. I'll catch you next time.